Hello, and welcome to CoValue App Tutorial. Let's move on to the second module, Expectations Valuation. For all those who are curious to know how the markets are valuing stocks, this module is designed to help you analyze the gap that exists between price and value. This module is also called Reverse DCF. The expectation valuation uses the discounted cash flow model. The module can be used for valuing any company except banking, finance, and insurance companies. We suggest you watch our Know Your Worth tutorial before proceeding with this tutorial, as this video draws information from the earlier module. In this module, we will help you to iterate what expectation value drivers built into the stock price of a company and what could be its value based on your expectations. Here, we have options to either create a valuation plan from Databank, edit an existing expectations value plan, import valuation from the Know Your Worth module, or create a valuation plan without Databank. For convenience, we create a valuation plan for Apple Incorporated with World Databank from the Expectations Valuation module. We can change country Databank to the respective country or exchange where the stock is listed and proceed after naming the plan as on the date it was created, which is 2nd December 2022. This example is just an illustration for the tutorial to understand the working of the app. In the basic information screen, you can see information like company name, prior period, currency, and number scale are pre-filled in the app. The prior period is usually the prior period ended for which the information is available. The currency is US dollars. Figures are in millions or billions and are set by default. Advancing to the prior period screen. Information like the sales and operating profit margin in prior period are pre-filled through the databank. The user is allowed to edit this data. Advancing to the balance sheet screen, non-operating assets and liabilities. The balance sheet non-operating screen essentially consists of non-operating items that do not contribute in generating operating cash flows. The non-operating assets and liabilities will need to be added or subtracted from the present value of cash flows from operating assets to arrive at the shareholder value or intrinsic value. This section is pre-filled and also displays the debt, non-operating liabilities, and the outstanding shares as on the previous closing day. This data is editable. The breakup can be viewed by clicking on the history icon, the top right of the screen. Users need to review the investments in affiliates, non-operating real estate, and minority interest to reflect their fair value, as these may be taken at book value. Now we advance to the capital structure and income tax screens. The capital structure gives the breakup of debt at book value and market capitalization of equity. The app uses market value of equity to compute the debt-equity ratio. Users can refer to history icon on top right corner of the screen to view the market price and cash income tax rate history for Apple. To insert the same ratio for the debt-equity ratio, users can just double-tap the mentioned area to copy it. Or you can change to the ratio you expect to maintain during the forecast period. The debt-equity ratio for Apple is assumed as debt at 5% and equity at 95%. Income tax during forecast period. The marginal income tax rate is ideally entered for the forecast period, assuming the tax rate is expected to stabilize to this rate on an average in the long term. For Apple, we have taken this as 21%. Advancing to the value driver screen. There are two scenarios, price and value, where expectation value drivers must be entered. The market price and market capitalization as on the previous trading day is pre-filled. In the price scenario, expectations value drivers need to be iterated to equate the shareholder value per share, which is the value computed based on inputs entered by the user with the current market price. This will assist you to analyze what is built in the current market price. In the value scenario, expectations value drivers need to be entered based on user assumptions. The shareholder value per share computed here will assist you to analyze the gap in price and value. Let us now enter the value drivers for both the scenarios for the forecast period. Initially, we shall enter the expectation value driver assumptions same for both the scenarios, and then we'll iterate and analyze what is likely built in the current stock price, and then change the assumptions for the value scenario as per user assumptions. Please refer to the history icon for historical data for each value driver on top right of the screen. For Apple, let us initially take a forecast period of 10 years for both price and value scenario, followed by the risk-free rate, which is 3.55%, as per the latest 10-year Treasury bond yield as on the date on this exercise. Users can refer to history icon on top right corner of the screen to view the U.S. Treasury bond yield for 10, 20, and 30 years. We have assumed expected inflation rate to be 3.25% during the forecast period. The expected inflation rate should be less than the risk-free rate. There is an alert if this exceeds the risk-free rate. The user may wish to proceed despite this alert. You may refer to the tooltips denoted by the I icon for better clarity for using the app. The sales and growth in the history section shows that Apple has grown by 11.46% CAGR during the past 5 years and by 9.68% during the past 10 years. We are assuming the company will grow at a CAGR of 10% for the next 10 years. The company reported an OPM of 30.29% during the prior period ended September 30th, 2022, and the average during the past 10 years has been 27.9%. So let's assume it will sustain at 28%. So we assume the target operating profit margin will be 28%. The history shows that the fixed asset to sales ratio until the prior period is 10.68%. We assume the fixed assets investment rate to be 12% during the forecast and terminal period. The history shows that the net working capital to sales ratio until the prior period is minus 11.61%. We assume the net working capital investment rate to be minus 11% during the forecast and terminal period. Now we look at cost of debt and equity during the forecast period. The cost of debt is taken by looking at the risk-free rate and the default spread of the company. The cost of debt should be based on the currency in which the valuation is done and is for the forecast period. The cost of debt for Apple is taken at 5.5%. Enter the cost of equity during the forecast period. Users need to refer the history icon to view computation under Capital Asset Pricing Model in the price and value columns. Here, you can iterate the expected market return and beta and compute the cost of equity based on your assumptions and enter the cost of equity in the expectations driver screen. Users can also deploy other models or just use expected market return, which is an implicit rate of return the investors expect in the stock market. The cost of equity for Apple is taken at 11.21%, as per the computation in the cost of equity during the forecast period by the app. Please review the computation in the cost of equity history screen. Advancing to the terminal period assumptions. The cash flows of the company continue post the forecast period and thus have value. Terminal period assumptions helps to forecast the cash flows into perpetuity. In this section, you will need to enter the expected inflation rate, risk-free rate, income tax, debt and equity ratio, cost of debt, and cost of equity expected during the terminal period. This will enable the app to compute the weighted average cost of capital during the terminal period. Users may click the history icon to check the history and CAGR of inflation for the currency for up to 30 years. Here we take 2% as the expected inflation rate during the terminal period. Ensure that the risk-free rate is greater than the expected inflation rate, as generally the Treasury yields incorporates the expected inflation rate. Here we take 2.25% as the risk-free rate during the terminal period. This is assumed as inflation of 2% plus real interest rate of 0.25%. The marginal income tax rate is ideally entered for the terminal period, assuming the tax rate is expected to stabilize to this rate on an average in the long term. For Apple, we have taken this as 21%. The history of the capital structure gives the breakup of debt and equity. Debt is at book value. Equity is taken at the market value based on the last trading closing price. The app uses market value of equity to compute the debt-equity ratio. The history displays the following: computation of debt-equity ratio based on current market capitalization, debt-equity ratio entered by the user during the forecast period. Enter the debt-equity ratio to be assumed during the terminal period in the terminal period screen. The debt-equity ratio for Apple is assumed as debt at 5% and equity at 95%. Now we look at cost of debt and cost of equity during terminal period. The cost of debt is taken by looking at the risk-free rate assumed in the terminal period and the default spread of the company. The cost of debt for Apple during the terminal period is assumed at 4%. Enter the cost of equity during the terminal period. Users need to refer the cost of equity during terminal period in the history section to view computation under capital asset pricing model in the price and value column. The cost of equity for Apple is 9.96% as computed by the app. We have iterated the beta for Apple from 1.16 to 1 as we expect the beta to be closer to market returns. Thus, the recomputed cost of equity comes to 8.9%. We enter the cost of equity as 8.9% for both price and value scenarios. The app will compute the weighted average cost of capital based on the assumptions entered. We now need to enter the terminal growth assumptions. We assume Apple's has pricing power and hence will be able to keep up with inflation in the very long term. Hence, the inflationary growth for Apple is taken at 2% as assumed in the weighted average cost of capital computation. The real growth expected into perpetuity should take into account the country GDP, growth rate, industry growth rate, and the world GDP growth rate. The user may click the history icon to check the history and check the CAGR of GDP growth for the country and the world for up to 60 years. Here we assume Apple's real growth to be in line with the world GDP, and hence the real growth is taken at 2%. You will need to ensure that the terminal growth is not greater than the weighted average cost of capital of the company. Now, let's compute. As you can see, the shareholder value is greater at $171 per share and the current market price of $148 per share. So, we need to iterate value drivers to equate the shareholder value per share to current market price. This time, we take CAGR of sales of 8% and compute. Shareholder value remains slightly lower, so we revise the CAGR sales to 8.1% and click Compute. The value comes to $148, very close to market price as on the date of valuation. Now we know what's built into the stock price of Apple. The market is discounting a compounded growth of 8.1% for 10 years with a target operating margin of 28%. As we had kept identical assumptions for both price and value scenarios, we need to change the value drivers in the value scenario based on our assumptions to analyze the gap in price and value. Here, we revise revenue CAGR at 10% for 10 years and the target year OPM of 30%. We also adjust the risk in the cost of equity, which is now changed to 10.15% for the forecast period by changing the beta from 1.16 to 1. Users can also use their own expectations of returns to arrive at a fair value and change it to understand the impact of cost of equity on the shareholder value. Now, when we click Compute, we have an approximate scenario in front of us that clearly shows the discrepancy between price and value of the stock. The shareholder value of Apple comes to $196 per share compared to the current market price of $148 per share, indicating that based on the value drivers assumed in the value scenario, there is a gap in price and value. This screen displays the results of valuation. Users can view the shareholder value and shareholder value per share of the company for each scenario. For detailed analysis, users can also click and view reports on free cash flows, valuation reports where you are able to see the present value as well as the future value per share play out on the basis of your assumptions. Users can either email the reports from here and share valuations with other subscribers or non-subscribers via messages in the app format. Thank you.